Welcome. Here for another In the Know podcast. My name's David Stone, Senior Manager in BerryDunn's Financial Services Practice Group. And as always, joined by Susan Weber. Susan, happy to have you here.
Thanks, David. Good to be here.
Perfect. Thank you. Yeah, another exciting quarter. You know, when we were prepping for this podcast, it never ceases to amaze me just how much happens in a relatively short period of time. So another jam-packed session for you all today.
I say all the time, there is never a dull moment in banking, right? I feel like that's a tagline we've adopted, never a dull moment in banking. But, you know, what's exciting about today, David, is we get to jump right in to see how the year ended, right? I know we're at the end of the first quarter, but the new quarterly banking profile information is out, accounting pronouncements for fourth quarter. What do you have for us today on that?
Yeah, and good point. I always look forward to this last quarterly banking profile, just rounding out the year, and I'll focus on a few bullets from the quarterly banking profile, and certainly we'll have our summary available for full viewing as well. So not the best news, but net income for the full year did decrease around 2.5% year over year. And this was driven by a multitude of factors, but probably the most prominent being higher non-interest expense, higher provision expense, and then higher realized losses on the sale of securities as well. So still seeing those persistent unrealized losses, and in some cases turning into realized losses in this case. So to that point, you know, I mentioned non-interest expense being one of the big drivers of the decline in net income year over year. So we actually saw the efficiency ratio, so that's non-interest expense as a share of net operating revenue, it increased to just over 65%, so around 26 basis points from a quarter earlier. So that's not year over year. It's just from Q3 24 to Q4 24. But, you know, I think is worth pointing out that we are still seeing that pressure on non-interest expense. On the accounting pronouncement front, really a pretty quiet quarter. No new pronouncements that we want to, you know, specifically call out. However, I will say that this year, 2025, will be the year that calendar year-end public business entities, just public business entities, have to adopt that new income tax disclosure accounting standard update. And again, you know, definitely refer to our summary for more details, but I think that'll be a big one that hopefully public business entities are already starting to take a look at and chat with their accountants and auditors about. Now, for the non-public business entities, they'll have one more year. That income tax disclosure, ASU, will be adopted for annual periods beginning after December 15th, 2025. So a little bit more of a reprieve there, a little more time to adopt that.
That's great.
So, Susan, I know it's been a busy start to 2025 in more ways than one, but I wanted to see, could you maybe provide us a quick regulatory update?
Sure.
As quick as possible, I guess.
Yeah, I know, right? There's so much that's been going on. I would say that one of the things that we certainly keep track of and are very much involved in is what's happening in the regulatory environment, especially with the changeover in agendas and policies as the new administration has come into Washington. Of course, they've replaced the heads of all of the regulatory agencies. There's a lot in the news around whether the CFPB will survive or not. And so I know there's a lot of there are pros and cons to all of these things. But one of the things that I would say in general is that the administration's made it very clear, and the folks that they've appointed into these positions have made it clear that that a right sizing of regulation is in order, and we have started to see that very consistently coming out of the agencies. They've been announcing, for example, late last week, they announced the rescission of the October 23 CRA final rule. And the intention, well, I should back that up. They have announced that they want to rescind the CRA final rule, and believe that they could go back to relying on the prior framework. We're seeing a new office. The OCC announced last week a new office being created that's really going to foster fintech and innovation partnerships. We've seen other policies and guidance that were in process. We've seen the agencies discuss not just CRA, but climate and others, saying that, we believe that our existing frameworks address this. We don't need a special call out for them, and starting to repeal. So I think in general, this was the year, ironically enough, for the agencies to take under advisement, are there regulations that we no longer need, or there guidance pieces that we need to sunset, and get that feedback from the banking community. And some of it seems to be naturally happening anyway as the new administration is coming in. So, and appointing the new heads of the regulatory agency. So if folks on the call are not necessarily already tuned in to these aspects, I would certainly recommend that people start watching them, because I think this is just the beginning of what we're probably going to see over the course of the next 12 months. And one of the things that I recommend is that you follow the agency pages, both the website and the LinkedIn pages, because we're finding that LinkedIn is being used to announce a lot of these press releases and other sound bites that the agencies really want to make sure are getting out there quickly. And I think if anybody has any questions around them, they certainly could reach out to us, and we'd be happy to walk through any of them.
Yeah. Thanks for that update, Susan. And a couple things I'll add on. So you mentioned climate and the OCC, coming out and saying like, hey, this is already captured and what we already have out there, so probably don't need something separate. Along those same lines, that the SEC in their climate disclosure rules, the SEC recently came out and basically said that they're not going to defend those climate disclosure rules. So even though they're out there, it's basically what's the term? Paper tiger. It's it's not going to be enforced under the new regime, if you want to call it that. I'll also mention. So you mentioned fintech. And a new office that the OCC created,
yes.
right? So the FDIC also just came out with a regulatory notice, or not even a regulatory notice, a financial institution letter, an FIL, with the intent of streamlining crypto activity. So you may recall that they came out with an FIL recently saying, hey, you have to let us know before you engage in any crypto activity. What this new FIL that they just issued here in March says is, no, you don't. You don't have to let us know in advance of, engaging in crypto activity. Really, this activity should follow the safety and soundness procedures, guidelines that are already in existence. So we are seeing relatively consistent messaging amongst the regulators in that regard.
Yeah, and I guess the one thing, I couldn't be a risk manager in my career and not say this, but I guess the one thing is the pullback on regulations does not mean that there's suddenly no risk. Right.
Sure.
It just means that there's an expectation that the existing frameworks and risk due diligence and thoughtfulness around understanding and managing risks that we encounter day to day is assumed, right? The banks remain accountable for that, as they always have. And, I really hope that people are feeling that they've got the right supports and the frameworks in place to continue to do this work and think about all the ways in which risk could potentially impact their business and that they're ready and prepared for it. So, again, just because some of these regulations are being pulled back doesn't mean, whoosh, vanish, the risks just disappear. Yeah. It just may mean that, they need to be incorporated into a more normalized framework instead of a specialized framework.
Yeah. Agreed. And Susan, I know we have our event coming up. I don't know if you just want to speak to that. Super excited about that.
Yes, we sure do. Our annual Evolve event, which is happening May 28th and 29th at Wentworth by the Sea. We're very excited. We have pre-conference activities on the 28th and then sessions for most of the day on the 29th, covering the economy, regulatory landscape in Washington, D.C., bank margins, balance sheet strategies, accounting and tax updates, leadership and engagement skills, even compensation and 401k and other things. Wow. So really a jam-packed day. We're super excited. We've been very, very diligently planning for this, and we're really looking forward to engaging with so many people in the marketplace. So if people haven't signed up, please go to BerryDunn's website and look for that link. Maybe we'll post it here also with the podcast.
Yeah, we'll make sure we have that, and we'd love to see you there for those that are able to make it. I think that's that's quite a bit for a short amount of time, Susan. Thanks as always. Thanks to our listeners. We're just scratching the surface on these things here. So definitely tune into the next episode. Attend our Evolve event if you can. There will definitely be plenty more conversation on these topics there. But thanks again, and we'll see you on the next In the Know podcast.